All right, so today we want to look at market structure. Now, in order for us to look at market structure effectively, I would like to draw our attention to the three types of markets that we have. So we have an uptrend, which means the market is moving upwards like that. Then we have a sideways market, which is moving within a specific range like this. Is also known as a consolidating market. We have that, then we have a downtrend where the market is going downwards like that. So this is what we want to do. Let me just erase that. Let me just erase, okay. An uptrend doesn't just move straight like the way I had shown. Let me just put a title here. So market structure. Market structure. So then the first one we want to focus on is an uptrend. Uptrend just basically means the market is moving upwards. But then I want to bring your attention to this. Like I had previously drawn, an uptrend doesn't just move in a straight line. It has, where did that go? Let me see. So uptrend, okay. So it moves in a structured manner. It's not just random like most people think. So it moves, it has an impulsive move, then it makes a retracement, an impulsive move, a retracement, impulsive move, retracement, impulsive move, and retracement. I'm sure you get the idea. That. Yeah, so it moves like that. Then these have names. So this part here is called, this part is called a higher high. So just denote that by H and another H. By the way, I'm trying to put H there and another H like that. It's the same here as well. You have H and another H. So then the importance of this, I'll explain in a bit. The importance of what I'm just doing right now. H and another H here. Yeah, then this other one is called a higher low, and that's also another higher low. So this higher low and another higher low like that. 50. So another one here, that's H and L. So that's HL, higher low, higher low. Then that's on top, it's higher high, higher high, higher high, just like that. Now what that means is this high is higher than this previous one. Hence the name higher high. All these are highs on the top side there. Then all these on this other side are lows. So this is a low, that's a low, that's a low, that's a low. But then to identify them, since the market is moving in a structured manner, you will say higher low because this low is higher than the previous low. That low is higher than this one as well. Same applies to highs. This is higher than probably the previous high there. This will also be higher than this. This will be higher than that. That will be higher than this. So with that in mind, an uptrend has impulsive moves. Now, this is referred to as an impulsive move. So an impulsive move. Then this is also referred to as an impulsive move. Then that as well. So we have impulsive moves and retracements. Just write that down for context sake. So we have an impulsive move and retracements. Retracements. So impulsive moves are these longer moves, these ones, where I've put the arrows. Then the retracements are these minor moves. So with that out of the way, what we would also like to note is this idea of support and resistance. Now I'll make another video explaining support and resistance in depth. But for now, what you need to understand is there's a reason why I want to drop in this just now real quick. So you have, let's write it away. You have support and resistance. Support and resistance. Now, you can think of support as a level the market has failed to go further down. You can think of resistance as a level the market has failed to go any further up. So what I mean is this level here, this high becomes my support level. That becomes my support level. Also, if I move this here, that becomes my immediate, sorry, I'm saying support, resistance level. Resistance level. Support is these other ones here, the lower lows, these ones. That's what is support. Think of it as floors and ceilings, or like the roof or ceiling. It means on the bottom side you have your support, on the top part you have your resistance. Just to hit the point home, let me see here. You can see from this point, the market failed to go further up, hence was pushed back down. And here it failed to go any further low, any lower than that. So that means this is my support level, that is my resistance level. Now let me just erase that. Let me erase everything I've drawn. Okay, let me remove as well. So now the importance of what I've just said, support and resistance. So the importance of support and resistance stems from the idea of break and retest. So we have this, we're still looking at the uptrend. This. It will likely come down and push further upwards. Sorry, further upwards. So now, in an uptrend, what you really want to focus on will be the higher highs or the resistance levels, like this one here. Then another one is that one there. Okay, so this, what I've just done here, proves one important point about the market. Whenever the market is in an uptrend, it means that it will always break the highs that it has made in order for it to continue to make that uptrend. So it will always break these levels. So there's an opportunity. Always break these levels. Always breaks those levels. Even this one here. It will always strive to break these levels. Then that's not all. Another good news is once it breaks that level, when a resistance level has been broken, it becomes a support level once the market goes back to it. So you will notice that the market always tries to go back to those levels. Now this gives you an opportunity as a trade. So here you can also see there as well. The market goes back to those levels. So that means you have an opportunity here to enter and there to enter as well. How would you know? How you can know? It's simple. Pretend everything here hasn't yet happened. You're just here. Once it had made this high, then failed to break it, went down. The moment it goes up, or the moment it just fails to break that level, you draw your line across that level. Then you'll be anticipating that once it comes back to that level, you'll be trading upwards because the trend is up. You always want to trade with a trend. So then that means you would have known about this opportunity. Same applies to this as well. Once the market was moving up, failed to go past this level, started going back, retracing. Then when it broke this level, the resistance level it had created, remember to make another high, then come back to this level and break that high as well. So you're just trading based on structure. So these resistance, which tend to support levels, give you key areas where you can actually do what? Enter the market to trade from. So that's what these things are. Then a practical example, let's quickly go to the market. Let me just drag this so that we can actually try it here on the live market. See what I was talking about. So if you pay attention, you notice that this market is moving in an uptrend because it has that impulsive move. It has this retracement. It has another impulsive move upwards. And it has this retracement here. Then another impulsive move upwards. So then, if you pay attention, you notice that this was the highest point the market had reached before it started going down. So that level there. And then also have this level as well. So just with those two levels, you can tell that even if you didn't know about this point, the market coming back to this level and then taking that trade, buying or going long, is because the only thing that you would have known is the fact that this market is in an uptrend. Then you know that characteristics of an uptrend is it will make highs, higher highs, and break them to make another higher high. What that means is you have this higher high, this one, it will break that one to form a new one. It also break that one to form a new one as well there. So now, as the market is doing that, it's giving you opportunities to trade. How are those opportunities coming about? Remember what I said earlier, whenever the market makes a higher high, it will always strive to go back to it and reach that level, which will now act as support. Previously, it was resistance, but then it will act as support. Remember, we said resistance is any level the market fails to go past. Then resistance, sorry, I swapped them. Resistance is any level the market fails to go past on the upside. Then support is when the market fails to go any further down. Like, for instance, this one here, this level, that's your support level. Why? Because the market has failed to go any lower than that. Hope that makes sense. Then I can now remove this. We don't need it for now. Yeah. So here's how the market is giving us opportunities. It breaks our resistance level, which will now turn into support. This here gives you an entry signal. Then the other thing to keep in mind is that impulsive moves are always longer than the retracements. Why is that? Because remember, if the market is moving in any direction, either it's moving in an uptrend or downtrend, other than consolidate when it's consolidating. If it's moving in an uptrend, in order for it to maintain that uptrend, the impulsive moves, by impulsive moves, I just mean these ones. This is an impulsive move. This is also an impulsive move here. Also, this is an impulsive move. What I mean is the retracements, which are these ones here. So like that one and this one. Currently, it's also forming a retracement there. So what I mean is these impulsive moves, the one I've just pointed at, those ones should be way longer than the retracement. Reason being is simple. If it's the market is supposed to maintain the momentum in one given direction, it means that the impulsive moves or the momentum towards that direction has to be higher as compared to the momentum pushing the market downwards. In short, the buyers need to have more pressure as compared to the sellers. That's what drives the market upwards. Then if the sellers start gaining momentum, it means the retracements will start becoming longer. That means this might retrace all the way to, let me get the R. This might retrace all the way, breaking past this and going maybe probably to here before it tries to make any attempt pushing upwards. Now this will mean that the buyers are slowly losing momentum and the sellers are taking over the markets. Hope that makes sense. So in order for you to be fully convinced that this market is going upwards, the idea I'm putting across is this. The retracements has to be way smaller compared to the impulsive moves. It has to be very, very small compared to the impulsive moves. Once they're almost the same, they start becoming like almost the same, of similar length. That means the market is losing steam. So if you are about to take any trade to the upside, then that means you need to be very cautious and make sure you use proper risk management and use smaller lot sizes, because it means buyers are losing momentum to the sellers. So with that in mind, I can remove this. Hope this has made sense. Then the other thing is you can also use Fibonacci levels to note where this. Okay, stemming back from the idea that I've just said, the one for the retracement doesn't need to be big. That's the basis for the Fibonacci. If I was to remove everything I've put here, and let's say I get my Fibonacci here, then we look at this. The impulsive move starts from here. Why am I saying that? Because we can't start it from here. Since there was this move, it had this smaller, this can also be like some Fibonacci level as well, pushing the market all the way up to that level and started retracing. So we'll start it from here. That's where the impulsive move starts from. Then I drag it all the way to the top. Okay, no, let me just remove it. Let's start it from an easier example so that you can see what I'm doing. I would rather we have a very clean example. So starting from there, that's where the impulsive move starts from, all the way to the top of that level. Yeah, so now you notice that this impulsive move is way longer, so it's all the way to there, compared to this retracement. Now, this is in a healthy uptrend. The same will also apply to like downtrends. We'll look at that later on in the video. So this means this is a healthy trend because the impulsive move is way longer than this retracement. And that's why these levels here, this level where it's at currently at 50 to like 61.8, this is called the gold zone or the golden ratio. That's where the market has to turn from. And that makes a lot of sense in a healthy trend because it means that the retracement isn't very big as compared to the impulsive move. What I mean is this, it's not coming all the way to like here to 78, which you can also trade. But what I would advise is if it comes to this and you want to take a trade, just be alert of anything. Most likely the market is about to retrace because it means the sellers are gaining momentum as opposed to the buyers who are losing steam. Hope that makes sense. But I'll make another video to explain the Fibonacci, how it's used, and the settings that I use. For now, I was just putting the point across, the one for the importance of the retracements being small. So using that same idea in a healthy trend, the retracements are usually small, maybe 50% of the move, or even less at times. Using that idea, that's where the basis for the Fibonacci level is. So then I can now remove this one. I think it has helped us. Yeah, so that's an uptrend. And then before you can take trades, remember you have to check other confluences as well. So you can look at the candlestick patterns that are being formed. What I mean is this, let's say you have an uptrend here, right? You have an uptrend like that. You have an uptrend. Then you've highlighted these levels here, the resistance levels that have tended to support these ones. You want to ensure that you use multiple confluences. What that means is I'll check where has this impulsive move started from. It has started from here. So what I'll do is I'll get my Fibonacci from this level and extend it all the way to that high. So this 100 has to be exactly where the impulsive move starts from. As you can see here, this 100 starts from there. Then you leave out all these. This 0.00% has to be on the highest point the market had reached before it turned. So that. Then these two are just my extension levels. where the market is likely to reach. So now, back to my point. What I was talking about is this. Now you see, this has more confluences. One, it's being supported by the Fibonacci. Remember, I said 50 and 61.8, this area here is known as the gold zone or golden ratio, because in most healthy trends, that's where the market usually tends from to continue moving to the upside. Then at the same time, this was also a resistance level that has tended to support. Then if you can also add in other confluences such as candlesticks, like bullish engulfing candles. In short, I just mean any bullish signal candles that you can get from there, either it being engulfing, you can talk about morning stars and the like. Here, if you can get that as well, or tweezer top, tweezer bottoms, all that can work. If you can get that confirmation from there, that means already you are trading with a trend, you are following market structure, you are using a key area. By that, I just mean a support level, that a resistance level that has tended to support. It's also being backed by the Fibonacci. So now this becomes an even higher quality setup, or an A plus setup as I call them. Hope that idea makes sense. So that was about uptrends. Now the same applies to downtrends, but it's just that for downtrends, we'll be moving in reverse. So for a downtrend, you have the market moving like this. Then there's a last idea I have on this that I'll explain. Then from there, so in a similar manner, this has lower highs. So lower highs, this will just be L, H. This applies to all that. Oh, let me just do this. Just say lower highs. There, then I just copy that. See if I can paste. This will be way easier than trying to write this. Then another one just right here. Yeah, then on the bottom side, we'll have lower lows. So let me just write that. Lower lows, I'll just denote it with LL. So we have lower lows on this other side. Now this, you notice, is similar to what we are looking at for uptrends. It's almost the same. It's just that this is inverted, or it's going downwards. They're just moving in opposite direction. And by the way, you don't really need to memorize these names, higher highs, lower lows. No. What you need to understand is market structure itself. Like, what are these things telling you, rather than just knowing them? The other point to note is this. When I talk about support levels that have tended to resistance levels, or resistance levels that have tended to support, what that means is, on a bigger scale, it's not just a specific line, like for instance, this lower low. It's not just a line like this. It's not a line like that, or here like this, or here like that. No, it's an area. It's an area, this entire area here. So that's why I'm using the rectangles. If you've noticed, I'm not drawing straight lines there. I'm using rectangles. Why? Because I understand that it's not a specific line that you can see, it's an area. So we have this area here, this one, that it's an area, not just a line. Just thought of throwing that in here so that you can get, so this also is an area, not just a specific line. Then we have this other one. It's also an area, not just a specific line. Okay. So let's now, let me bring your attention to something. What's happening with this? Our drawings just disappeared. Let me just do it fast. Like this. Yeah, then that area there. Then we have this other one here. Now, here's what I want to bring your attention to. Remember, on this other one, for a downtrend, our focus is going to be the lower lows, these ones. Remember, for the uptrend, we were focusing on, just draw a mini uptrend here. And so for the uptrend, we were focusing on these higher highs, these levels here. We were focusing, drawing our key levels on these. We were focused on drawing. How come it's not? Yeah, we were drawing it on these. That's where our focus was. But now for this one, it's the other way around. We are focusing on the lower lows. Lower lows, lower lows, lower lows. I just thought that's important to like throw in so that you can be getting the differences in terms of how you should be looking at downtrends and uptrends as well. So then in a similar manner, an uptrend always has these support levels and resistance levels, but we focus on the support levels. So once the market bounces off the support level, it goes back up, forming this mini retracement, pushes with an impulsive move, breaking this support level here, and then going down and coming back, that becomes a resistance level. So whenever a support level is broken, it becomes a resistance level. The market goes back to it. If a resistance level is broken, it becomes a support level if the market goes back to it. So there's that name shift. So like here, it no longer is a support level, but it will be called a resistance level. Because remember, we said resistance levels are areas where the market fails to go any further up. Support levels, areas of the market where the market fails to go any further down or any lower. So once the market comes back to this level, what are we anticipating is going to happen? We're anticipating that this market is going to continue going. This keeps giving me trouble. Okay. We're anticipating that the market is going to continue going downwards. Hence, from here, we're going to do what? enter the trade. Now remember, I said you don't just enter a trade blindly, you need other confluences. So you can still go back to the Fibonacci, start where this impulsive move started from. From there, remember my point 00 has to be on the highest point or lowest point the market has reached. So in this case, it's there. So you notice that this turning here was exactly on our golden ratio, this here. So that means from here, I have even more confidence that this trade is going to play out. Why? Because it's on the golden ratio, the market is on a key area. Moreover, I'm trading with the trend. I'm following market structure. So I'm putting the probability that this works higher on in my favor. So that's what this means here. So let me remove the Fibonacci and let's look at a practical example of this. So I've removed everything. So let's try to find, let me see, do I have a downtrend? Let me see if we can look at any downtrends. Okay, so you can see this is clearly downtrend. We have an impulsive move. Then we have this minor retracement. Remember, I said retracements have to be very small compared to the impulsive move. Why? Because if the retracement is very big, it means that the market, in the direction it's going, it's losing steam. So if it's a downtrend, it's most likely going to reverse. If it's an uptrend, it's also likely going to reverse in the opposite direction. So like from here, you can see that we started losing steam. This impulsive move wasn't very strong. Then I can predict that from here, most likely this market won't continue going any further down. It's likely to turn, and that's what happened. You can see from here was that impulsive move upwards. Then from there, there was a drop here. Now, my point is, once you see this short impulsive move, you need to remember that most likely this market is about to reverse. Hence, you have to, if you still want to trade cautiously. But if you are like me, just stay away from the market and wait for the reversal and trade in the opposite direction. So for me, I would have drawn a line here and waited till maybe a test and the confirmation that we have changed structure, and I start trading to the upside rather than risking money on a trade I'm not even sure that it's going to, okay, not I'm not sure, which has very little chance of playing out as you anticipate. Okay, let me go back to this now. Back to our point. So this is a clear downtrend. What I wanted us to test out is this idea of the Fibonacci. So let's see. From here, that's like the highest point. Remember, I said where the impulsive move starts from. I was to drag this. I said where the impulsive move starts from. Someone might think it probably started from there. But I would argue that this on itself is some kind of a mini market structure that it's forming to there. Then from here, this is where now there was this big, massive drop to the downside. So with that out of the way, now let's look at where this market turned from. Remember, I said 61.8 to 50, between that level. You can see exactly that's where this market turned from. So I can even circle this level. But what else gives us confirmation? I'll talk about candlesticks in another video. I'll explain candlesticks anatomy. But in this case, we have this bearish engulfing candle. Moreover, if you look on this other side, you notice that this has been a key level in the past. Just drag it a little bit up. Remember, I said it's an area, it's not just a specific line. So you can see that at some point in the past, the market had tried to break past this level, it failed. And again, it tried here, failed as well. There were many attempts to like break this level, it kept failing. So this means this was a strong resistance level. Oh no, support level. Why? Because the market was trying to go down from the other side. It's because I'm pushing the arrows upwards, that's why I got confused. But yeah, it was trying to break past this. It kept on failing, failing, failing. Hence, this was a strong support level. Once the market managed to break this, and when it pushed up, it came to that area. And that aligned very well with the Fibonacci. Now this gives you more confluences. By confluences, I just mean more confirmation to take the trade, and it's more likely to play out in your favor. Moreover, it had this bearish engulfing candle. So this could have given us a very good trade. So you probably would have entered from there. Selling is called shorts. So you probably could short from there, put your stop loss just above this 78.6. Then you can put your TP1 right around here. Yeah. So you can put your TP1 there. And then you would have had a risk to reward of about 2.8. That means for every dollar that you are risking, you are getting $2.8, almost a 2 to 3 risk to reward ratio, which are like the ideal ones that I like to go for. So once you have this system, it means with any market, if you do this and everything has aligned, you take trades only that meet this criteria. Already you have an edge over the market. Why? Because you'll be putting odds in your favor rather than just randomly taking trades anywhere in the charts, which is what makes a lot of people not to even succeed. Then the other thing is, let's say if you're not able to spot those levels I was talking about, like for instance, let's say this is an impulsive move, then it had made this retracement, then there's this impulsive move going like that. In case you're not able to see this, you can always, let me just remove those. You can always change the market to a line chart. Now, a line chart will help you to identify those levels fast. Why? Because you just see that this is the highest the market has had gone. You draw your line. Then once the market breaks past that level, it comes back to it. What do? You trade going to the upside, like that. Same applies to a downtrend. Just look at the lowest points the market had failed to go any further down. So we had like those two. Then we had this one here as well. Can drag this all the way. Can drag that all the way. Let me see. Drag this all the way to there. So now you can see, once you have that, now you are putting the market in perspective. This means it's just going to trade downwards to that level. Why? Because you know in the past, the market had failed to break this level, so most likely it might react here. So you want to exit immediately as the market is approaching this level. But your entry is from that level going downwards. Why specifically this level? Because remember, the market in the past previously failed to break that level twice. Hence, when it broke it, it went back to it, and then we expect it to drop in a healthy downtrend like that. So after you are done with your analysis, you can now go back to candles like that. Then you see that now this will be a little bit easier to trade. I go back to this other one, you can see it's now easier to like spot the higher highs where you draw your lines for uptrends and the lower lows where you draw your support and resistance levels, or let me just say support levels for a downtrend and resistance levels for an uptrend. So I think that's all about, oh no, the last market we haven't looked at. So then the last market we're supposed to look at is a consolidating market. So what a consolidating market is, like the name suggests, it means it's moving within a specific range like this. Like that. It's failing to go to break past this resistance level or to break past this support level. But if you're new to trading, I wouldn't recommend you trade such type of markets. The reason is simple. It's because once the market doesn't have a definite trend like here, it means it will break out on one side with an impulsive move. So that means it can wipe you out entirely. So that's why these ones are a little bit tricky and shouldn't be traded if you're new, unless if you know what you're doing. So here's a trick that you can use. Since remember, I said in the beginning, in the onset, I said you can tell the strength of a market by three things. One, it needs to have short, let me just write that down. It needs to have short retracements. That's one. Two, you need to have momentum candles. Three, you need to have very steep impulsive moves. Very steep impulsive moves. What that means is this. So in order for you to identify how strong a specific trend is, let's assume you have an uptrend. What just happened? Okay, I hope you wrote what I had written down, or you can just rewind this, because due to time, I won't write them again. You can just rewind and write them down somewhere and then be following using that to what I'll be explaining. Now, so here's what I mean. You have this, right? You have an uptrend. So by just looking, you can already tell how strong the trend is. How? So you can tell how strong the trend is by one, momentum candles. By momentum candles, I just mean you have like very large candles like this following each other. Maybe this one and another very large candle. In that direction, the market is going. So you have large candles like this, which have very little wicks in that direction. So that's one. You see, you spot a few of these, you know that this is a strong trend. Then it has short retracements like this one here. By short, I actually mean it shouldn't be more than 50 to 60%. 50% is okay, 60% is okay, 61.8 is also fine, the Fibonacci level. But if it goes way beyond that, just know that the market is likely going to be reversing soon. So you don't really want to take trades in that type of market or in that scenario. So then the last one is, I was talking about the steepness of the impulsive move. So if I was to draw a straight line here, let me put a horizontal line here and explain what I mean. Then I'll put, okay, no, even better, I can use, let me remove this. We'll go back to some math a little bit. So I can start from, this has to be straight. And ensure that that is straight as well. Oh, okay. This is some math. That's a 90-degree triangle. Seen that, right? Now, if this, the smaller this is, the distance between this vertical line and this, the line for the impulsive move, the smaller this is, then the stronger the trend is. Because generally, if the market is moving upwards, it means that it will try to almost make, if it's a very strong trend, it will try to almost make vertical lines. So it will try to almost make the trend to be vertical, though it can't be vertical because you have like opposing pressure from the sellers, but it will try to make this as much as possible to be a straight line like this. So then the idea is this: the closer this is to a straight line, the better, meaning the stronger the trend is. So in our case, this one, it shows that this is a very strong trend. But you can have a problem if, let's say, the market you are saying is an uptrend, but it has like this type of a move. This already shows you that this uptrend is very weak. Hence, you don't want to take trades in this. You would have to wait. Or if you want, you can take, but be very conservative. But if it's closer to this, like this one here, the closer it is to this, or the closer this is to being a straight line, the stronger the trend itself is. The same applies in the opposite way for a downtrend. Yeah, so with everything I've said, I hope everything makes sense. I'll see you in the next video. And I'll be talking about support and resistance in depth. Also, I'll create a new video for top-down analysis. and how you can use it in our daily lives. So thank you for watching. Don't forget to subscribe, share, and like.